Hey guys, welcome to my channel. It's Nivesh Patshala. I hope you are all doing great. So we have started a series in corporate finance. This is our second video. In the first video, we have learned what is capital market, who are the players in capital market, what is the secondary market, and what are the corporate funding life cycle. We have also discussed the two key main areas in corporate finance. So if you haven't watched, so check it out. So today we will discuss about valuation of business, how to value a business. So in this session, we will learn method of valuing a business for an acquisition. Second, how a business can be valued by using enterprise value and equity value. And third, how a business can be valued using discounted cash flow. So these 3 points we will discuss in this video. So let's begin. So the methods of valuing a business. So when you acquire a company, before you have to value that company. So there is total 3 methods or 3 techniques to value a business. So the first is public company comparative. So what is public company comparative? It's easy. It's a normal method. It's a public company we compare with the same similar company in the same industry. That's the normal way. So there is total 2 metrics for valuing a business. The first is relative valuation. Second is equity and enterprise value. Okay. So we use these metrics to value this method. Okay. Let's move on to the second method. The second method is precedent transaction. It's easy. It is same. What do we do in this method? We just look at the past that in the past acquisition of similar companies to estimate what the company might be worth it. We just look in the past and see what acquisition what type of value is made on that acquisition. Similar. So we use same metrics for this method also, relative valuation and equity enterprise valuation. Okay. So then the last method, which is discounted cash flow. So what is discounted cash flow? It is a valuation method. It's a popular valuation method used to estimate the intrinsic value of the company based on the cash it is expected to generate in the future. So you have to find the present value of the future cash flow. That's all. It is the same. So there is also a two metrics is standalone valuation and synergies. This matrix is used for finding the DCF model. So these are the 3 methods, and we will after that we will discuss about what is equity, what is enterprise value also. Now we will discuss enterprise value versus equity value. Many of you think that these two terms are similar, but these two terms are totally different. So first we discuss the enterprise value. So what is enterprise value? It is the total value of a company representing the theoretical cost to acquire that entire business. Okay. So it is a total value of a company. Okay. Now let's move on to the 2 parts. Enterprise value is divided into 2 parts: debt and the equity value. So you all know that what is debt. Many of you take loan from the bank to purchase machine, to purchase raw material. So this is debt. And next is equity. So if I tell you what is equity, so equity is nothing but a portion owned by the shareholder of a company. Okay, the value that belongs to the shareholder after all liabilities, debt are deducted from the capital asset. So this is called equity. Okay, so how to find enterprise value, or how to use the enterprise value to value a business. So there are 3 main formulas. So first is enterprise value divided by EBIT. Second, enterprise value divided by EBITDA, and third is enterprise value divided by sale. You use this formula to value a business. Okay. Second, so after finding equity, so you also use the formulas to value a business to equity value. First is price by earning. Second, price by book, and third, price by cash. So these are the formula you use to value a business. Okay. So now we move on to discounted cash flow. It is most popular and important method for valuing a business. So what is discounted cash flow? We already discussed that discounted cash flow is an intrinsic value method used to estimate the present value of a company based on the cash flow it is expected to generate in the future. In the normal way, the present value of a future cash flow. Okay. So there is a total 7 to 8 step to find DCF, but today we will just use the formula, or we will discuss the formula which is used normally in every DCF model. So which is basic perpetual growth model. Okay, it's a normal model used in every discounted cash flow. So this is the formula. Don't be scared, it is very easy formula. TV equal to FCFF into 1 plus G divided by WACC minus G. So don't be scared, it is a very easy formula. We will break down. So first is TV. TV means terminal value. So what is terminal value? Suppose we are forecasting a business for 5 years. So after 5 years, the value which is left is called terminal value. Okay, it's easy. So after forecasting the period of a company, the value which is left is called terminal value. That. Next, we move on to FCFF. What is FCFF? FCFF is free cash flow to the firm. The cash flow which is left to the firm, this is called free cash flow. After deducting every expenses, everything, the cash flow which is left in the company is called free cash flow. Okay. So next one, move on to the growth, G. What is G? It is a organic growth of a business. So every year to year, the business grow 5%, 10%. This is called G. We are taking, this is G. So next, move on to WACC, which is called weighted average cost of capital or cost of capital. What is this? It is the average rate of return that a company must earn to satisfy all its capital provided, both shareholder and lender. That's all. It is the average rate of return from invested capital. That's the main definition. There is a formula, lots of things we will discuss on the next video. Don't be worried. So first we'll know what is WACC. Next, G. Again G. This is the organic growth of a business through acquisition. Means suppose if you acquire a business, if your company growing year on year 5%, suppose, and after the acquisition the growth is become double, 10%. So this is here it will be putting this in formula. Okay. So this is the whole valuation of a business. Next video we will learn how to calculation part, how to learn that vision, how to value a business from the same model step by step we will learn. So thanks for watching the video. Please like and subscribe, and if you haven't seen the video 1, so check it out. So let's goodbye and signing off.